Hello, and welcome to myfinancesteacher.org. Let's talk about energy today. Not green energy, but instead let's talk about oil and natural gas, as I think there are some interesting developments. Oil and gas is now dirt cheap, or has it actually become undistinguishable from dirt and mud? As I mentioned, despite the fact that share prices of a lot of energy companies over the last several months have really done terribly badly, I think there are some interesting, positive developments that are worth your attention here at myfinancesteacher.org. So first of all, the new report from Evaluate Energy states that there has been a significant increase in M&A activity in oil and gas industry in Q3. And that's actually after this M&A activity reached the historic lows back in Q2 with the pandemic hitting all of the markets at the same time. Is this increase in M&A activity indicates that the companies that are in the know in the industry are picking up low premium bargains at the moment? Possibly. And if that is the case, coupled with relatively good dividends that are currently paid by some of the most stable, largest oil and gas companies in the world, you possibly might want to allocate at least some capital to these energy companies. Next, let's have a look at bankruptcies in oil and gas industry, both at the oil field among explorers and producers, as well as among the oil field service providers. We see that recently bankruptcies among explorers and producers have accelerated, coming close to nearly 20 bankruptcies in the second as well as the third quarter of this year. Although that is still low compared to the previous high at over 30 bankruptcies back in the middle of 2016, we still see that these bankruptcies have actually accelerated over the last couple of years quite substantially. We can see that more clearly if you look at the oil services companies, which have matched the previous high on bankruptcies back in the middle of 2016 at just under 30 bankruptcies just in the third quarter of this year. And that's over the double amount of bankruptcies even in the second quarter of this year. The next question from here is, how do these spikes in bankruptcies relate to the valuations in energy industry and possibly to some buying opportunities? Well, compare this chart with this monthly chart of crude oil. Currently the price is, say, somewhere around $40, just as it was in the beginning of 2016 after a substantial drop down from nearly $100 all the way down to that, say, around $40. Notice that the low at around $26 actually took place in early 2016, while the spike in bankruptcies took place in the second quarter of 2016, meaning that these bankruptcies are somewhat of a lagging indicator. Now moving back to this year, we see that the low actually took place in the first quarter of this year. And since then, crude oil price has actually recovered quite nicely. And again, as a lagging indicator, these bankruptcies are possibly spiking up now to confirm that the low has been in if we see substantially lower bankruptcies in Q4 of this year. As you see, for example, back in the second half of 2016, these bankruptcies dropped off quite quickly as crude oil price recovered. That's why if we see a significant drop in these bankruptcies for next quarter, that will be one of your confirmations that the worst in energy industry is behind us. Similarly to bankruptcies, number of oil rig counts is another indicator that might be of interest to you. Notice here that since the middle of this year, the number of oil rigs has actually increased a little bit. So potentially we have seen the low for oil rigs under 200 oil rigs back in August this year. And if you compare this chart with the price chart again, you will see that it does seem to be somewhat of a lagging indicator, especially if a similar thing happened back in 2016. Now let's have a look at the oil rig count back in 2016. We see that this indicator bottomed again in early summer of 2016, while the oil price has actually bottomed in February of 2016. Again, that is a lagging indicator, and if we see further recovery over the next several weeks, that again will be another confirmation for you that we have seen the worst in the energy industry. Next, moving on from quarterly, monthly and weekly charts down to daily chart of crude oil, one word to summarize this chart would be that it looks promising. A few days ago, crude oil bounced off from this support zone at just under $35 based on the May highs and June lows. During this decline in crude oil price since the beginning of September this year, we've seen multiple pokes through the lower range of the Bollinger Bands, and those Bollinger Bands have been relatively wide at some moments in time, making those pokes rather significant. We also see a positive divergence on the 14-day RSI, where the price is showing us lower lows between early September and early November, while RSI is showing us higher highs. This is another bullish indicator. And more recently, over the last 2 to 3 days, although crude oil price dropped a little bit, that is because it bounced its head on these 20-day and the 50-day moving averages. And I think over the next several days it will take another attempt at slicing through those averages to the upside. Although over the next several weeks, as winter approaches and as more people sneeze and cough a little bit with the health concerns, we might actually see crude oil continue some weakness before it recovers later on. That would give you this extended inverse head and shoulders pattern with very long double shoulders on either side. Next, moving on from crude oil to energy companies, this is XLE, the energy sector within S&P 500, and the black line here is crude oil price. We see that over the last several months, all the way since early summer this year, energy companies, XLE, have actually underperformed even against crude oil itself quite dramatically. And although XLE is down over the last several days, I would still qualify this chart as somewhat positive. Firstly, we've seen the positive divergence on RSI versus the price chart, where the price has given us a lower low, which was not confirmed by the RSI. Secondly, back in late September, RSI has been quite deeply into overbought area, showing that XLE at that time was relatively cheap, and it is still cheap in my opinion. We have also seen multiple pokes through relatively wide Bollinger Bands, which is also a sign that at least a relief rally is upcoming. And you might notice that the price chart is likely to give us an inverse head and shoulders, similar to what is happening in the crude oil itself, possibly over the next few weeks. This right shoulder, though, it might actually be extended a little bit as the tax loss season is approaching back in late November, early December. And as energy has been doing pretty badly this year, there might be a lot of investors who will want to sell into that tax loss season. And in addition to the opportunities back in late October as well as late September, this tax loss selling over the next several weeks might be yet another chance to pick up some cheap energy companies. And in our fictitious portfolio, you know that we are already allocated quite significantly towards energy companies. And of course, I have something similar happening in my personal portfolio as well. On the other hand, we do still have some cash to take advantage of some buying opportunities possibly coming up into the tax loss season.